Hello, everybody. Thank you so much for joining us on the Modern Ventures Speaker Series. I am so excited today to welcome Spencer Levy. He is the chairman of America's Research and senior economic advisor for CBRE, which, as you should all know, is the largest commercial real estate firm in the world. He is actually one of my favorite speakers. It's very rare that you get a funny and exciting economist to talk to you. And so I'm honored that he was able to join us today because he is, he's amazing. So he's gonna, we're gonna talk a little bit today on, Spencer's views of things that are going on in the world, this crazy post-pandemic world, how it relates to the real estate industry and technology overall, and cities, and what we can maybe expect in the future. So welcome, Spencer.
Thank you, Constance, for having me. In addition to be funny and entertaining, I hope I'm accurate too.
Perfect. All right, yeah, we like that. We don't want to provide fake news. We're over that, right? All right. So first of all, geez, what a year. So obviously a crazy and really difficult year in particular for office and retail. Certainly student and senior housing, hospitality. What do you think though? Like, is it about to get better, or have we not seen the worst of it yet?
Well, there's an expression, and I'll use several of them on this discussion. It's always darkest before the dawn. And it's going to be dark for the next quarter, at least, until we get this vaccine fully distributed and get the virus under control. So that's the bad news. The good news is once we get out of this thing, we're going to get out of this thing strong. And why strong? It's not just because of the amount of fiscal and monetary support. It's also because of a very well-known economic effect called pent up demand. And that pent up demand, as my good friend and colleague Henry Chin calls in Asia, revenge retail. People want to spend. And people
shop.
Yeah, you're right. And people can spend because the savings rate in the United States is now higher for most people today than it was pre-COVID. And we are going to see stores and cruise ships, believe it or not, price their services down to zero so people get on them. I mean, you probably think I'm nuts. Oh, nobody's ever going to get back on a cruise. Well, let me disabuse you of that notion, because I am the research guy. And prior to this, I did some research. And I found out to take a 3-day cruise from Fort Lauderdale to the Bahamas is $139. And the only thing better than cruising is cruising for free. And thank God for that. And you know why? Because 2/3 of the American economy is consumer driven. And the consumer is going to drive us out of this with an unprecedented amount of government support.
Well, so very good news. Do you think, there's in the articles, even just today, we're seeing more and more corporations start to downsize their space, and certainly this trend, this work from home thing that's been more than a trend, we might see continue as a trend, right? So I guess while there's pent up demand, do you think that there's going to be the same kind of pent up demand in the office space? Do you think that this remote working, they've been forecasting it for a long time, but do you think it's now finally here? This is actually a fundamental shift?
Well, the phrase that we're using a lot, and I'm sure you are as well, Constance, is acceleration of trend.
Yeah.
And the question is which of these trends that have accelerated will be durable and which of them will not be durable. And there will be some durability to the work from home trend. And as you are so accurately pointing out, we've been talking about this for years. In fact, we came out with a report just prior to the COVID crisis that talked about the rise of the fluid workplace, which is just this: people working sometimes from home, from a Starbucks, from a self-driving car when they come around. So we knew this was coming, and yes, some of it accelerated. And when you talk about the surveys that you're referring to, the corporate CEO statements, I do want to give you one very large grain of salt to take it with, because I'm an early 1980s music fan. And there was a band in the early 1980s called Asia. I don't know if you remember that band. Do you remember that band?
You remember that band.
Okay, well, you know what? They had a great song. It was called The Heat of the Moment. Remember that song? What that song was about was that in the heat of the moment, people make bad decisions. And then once they're out of the heat of the moment, they'll be making better decisions. It's precisely what's going to happen here with the survey results. Once people are back in the office, they're back with their colleagues, they're going to realize what we've known for 20 years. For most people, going to the office is a want, not a need. And why do people want to go back to the office? Well, let me just first cite a study because I'm the research guy and I just got to give you one study. There was a terrific study in 2015 by Stanford University, which said that work from home can work. It was all about work from home from a cost standpoint, from an efficiency standpoint. But you know where it doesn't work? From a productivity standpoint. It doesn't work from creating a corporate culture you want. It doesn't allow you to attract and retain talent. It doesn't help you grow the top line. And I hate to make a shameless plug for my alma mater, Harvard, but according to the Harvard Business Review, great companies focus on productivity. They do not focus on efficiency. And that is what's going to happen. Yes, the big cities are going to suffer more in the short term. And one of them is Chicago, where I know most of you are there, and I love Chicago, but it will come back just like New York and San Francisco. And I'll give you one other thing. We recently studied San Francisco and New York to determine, well, who's coming back? Well, you know who's coming back to those markets? The most highly educated, highly talented, highly productive employees are coming back to those markets, even in the future, even if they have a net outflow of people. Why? Because they have a virtuous cycle of infrastructure, of people, of talent, of capital. You can't just replace it, pick it up, and move it all to Raleigh or to Charlotte or to Nashville. Now, those cities are going to grow too, but a disproportionate number of the most highly talented folks are still going to go to the major markets, and that's going to drive real estate demand.
Yep, makes sense. I was hoping to get more of them here to Chicago, but I get it.
Believe me, they should go to Chicago. It's a great city. My favorite restaurant's there, by the way. Gene and Georgetti.
Yes, for sure. So let's talk about sort of the impacts of the new administration. How does that play out with what we're going to see in the next few years there?
Sure. Well, I mean, I think there's mostly good news, but there are some things that cause some concern in real estate. But let's start with the good news. And I think it comes down to the combination of both the new administration and the flip of the Georgia Senate seats to Democratic control. And just as a side note, I had a conversation about this with 5,000 people last week on one of my mass conference calls. And on that call, we had the Real Estate Roundtable. We had Dave Camp, the former chairman of the House Ways and Means Committee. And we debated not only if and when some of the changes are going to occur, but I'll get to that in a moment. Big picture is this. Assuming President Biden gets through most of what he's suggesting from a fiscal standpoint, more close to that $1.9 trillion package, some or all of this infrastructure, that's a very good thing for the economy in the short term. Very good, because we need as much fiscal wind in our sails as we can get. And it's also very good for commercial real estate. And why is that? Because the number one risk, maybe not the number one risk, but one of the biggest risks in commercial real estate is higher property taxes. Let's face it, state and local governments are broke. And I'm not going to say they all have clean hands walking into the COVID crisis. I am going to say they're broker than they were because of the COVID crisis. And about $300 billion of what Biden's plan is to support them. And why is that good? Because if we don't support it through the federal government, they're going to try to raise local property taxes. So I think the single biggest thing that will benefit the industry in the short term is more fiscal stimulus, macro, and less risk of property taxes. But here are the things that people have raised of concern with the Biden administration for the commercial real estate industry. They have to do with taxes. One of them is the potential elimination of the 1031 exchange. And just so you know, the 1031 exchange was a big deal last year. It was about 30% of all multifamily transactions, and it was 21% of all industrial transactions. A big deal, given that all we traded last year was industrial and multifamily. But so that's part A. Part B is, are we going to change capital gains treatment to have higher capital gains taxes? Are we going to have higher corporate taxes, which is going to dissuade folks from relocating to the United States? And then there's regulatory issues around the most politically sensitive industries, including oil and gas, healthcare, military, and then, of course, technologies increasingly in the crosshairs. So those are the kind of concerns that are happening. But I think the key question for investors is not if, because we don't know the extent of if is going to happen. And it's not going to be any extreme that people think, because according to the Real Estate Roundtable, there are many senators that are, quote, Republicans in Democratic clothing. So the worst impulses that might be more challenging aren't going to happen. But it's when. And so the debate we had was, well, if these tax changes happen, are they going to happen in calendar 21? Now, while there is a chance they happen in late 21, it's more likely they happen in 22. And we believe that, number one, because that's how most of these tax changes happen, is after the calendar year, there's a cliff event. But number two, I'm very encouraged by President Biden's choice of Janet Yellen as Treasury Secretary. I was a big fan of Janet Yellen's when she was the Fed chair. I'm a big fan of hers now, but she was a well-known, quote unquote, dove then, meaning keeping conditions accommodative as long as possible. I don't see that changing during the pandemic. So yeah, modest risk of more taxes, most likely that they're going to occur next year is the big negative, but the big positive is all this fiscal stimulus. And I certainly hope we see an infrastructure package, but I'm a little bit more skeptical about that.
So speaking of the stimulus money, I mean, when you're printing all this money, the big risk that's also on top of people's mind is inflation, right? So, one argument is that real estate does better than, your cash investment and because of inflation. But, I guess what are your thoughts there? How does that impact the economy and real estate?
Well, Constance, you and I think most of the people are in Chicago right now. Is that correct?
People are everywhere.
Everywhere. Well, people are everywhere. For the 2 or 3 people on this call that are in Chicago right now, it is the home of Milton Friedman, the great economist, Nobel Prize winner, University of Chicago. Yep. And if Milton Friedman was on this call today, and it would be a pretty good get since he's been
that'd be a pretty good get. Yep.
He would say, because of the increase in the money supply, you have nothing but upward pressure on inflation. The only thing that matters is the money supply. Well, now Milton Friedman is going to roll in his grave in this comment. I was like, no, Mr. Friedman, Nobel Prize winner, maybe greatest economist of all time, not named John Maynard Keynes. That guy, I'm going to say, look, there are mega forces that are pushing down on inflationary forces. And that includes the aging demographic, too much cheap money out there. And I see that cheap money every day, too much cheap labor with globalization. And then innovation itself is deflationary as you use less stuff. Believe it or not, electric car is more deflationary than gas power because it's simpler. It doesn't break down as much, doesn't use as many parts. So ultimately, yes, there are going to be modest inflationary forces due to the increase in money supply, but they are going to be kept in check by these forces. And the best example, and it's not a great example because there's other things to be said about it, is Japan. With that same aging demographic, have had massive increases in their amount of fiscal debt at the federal level, and they haven't seen inflation at all. So I would like to see a little bit more inflation. We will see a little bit more. You saw the 10-year pop up about 40 basis points since the election, and that was because of the fiscal stimulus. But we think it's going to be well in check. We do think that the 10-year could get to about 1.75% by the end of calendar 21, a little over 2 by calendar 2022, but then top out in the 2.25 to 2.5 range long term. And that is very, very low by any historic measure.
Okay. So that's great. So you talked about, how technology can have a deflationary effect. And what else are you thinking in terms of just moving the needle, whether it's in the industry, whether it's about the economy? Like, what are you seeing the big forces on technology? And then,
well, look, we have 2 basic industries that before the pandemic, we thought were going to lead us out of this, and now we think are even more so. And one was tech, the second was healthcare. Mm-hmm. And we stand behind both. We think that the mega forces of technology are going to make life easier, faster, better, all the things that you think it's going to be. And it's going to be the fastest growing industry. And there are going to be new subsectors in it that cross into healthcare, most notably life sciences. I mean, let's just call it what it is. The vaccine coming in less than a year was a miracle, but it was a miracle that was driven by technology, right? Yeah. Those kind of miracles are going to happen more. And so you're going to see more technology, but also in subsectors like life sciences. And I guess the question you should be asking is not what, but where, right? Because the clusters of technology historically have been in Silicon Valley, San Francisco, and then life sciences a little bit broader in San Diego, Boston, et cetera. Is it going to expand? The answer is yes, it is going to expand, but you're still going to see the dominant clusters in the old school places. Why? Because it's very hard to replace them. It's hard to replace the healthcare systems, the hospitals, et cetera, that drive life sciences, and the venture capital that drives technology. But you are going to see an expansion of it to other cities like Denver, like Nashville, like Raleigh, North Carolina, like many of the cities in Florida, you're going to see a definite expansion because they're the two scarcest things in the world from a real estate investor standpoint are number one, large pockets of talent, and number two, large high yielding assets. And many of the secondary markets are increasingly providing both.
So I want to shift us to your view on a couple of questions on the stock market. So one that might be a little bit easier and one from the audience about SPACs. I'm not sure if you've been following them, but get a sense of your thought there. But let me start with what you said about healthcare and tech really kind of driving being big drivers recently, and in the stock market for sure the technology has been helping us to continue even in these times, just continue going up and to the right. What about real estate? Like how one sector goes up, or just other forces having an impact? What do you think the ultimate impact is on real estate and the stock market?
Well, look, the stock market may be irrational at times. And by the way, I should note that I spent the entire morning trading GameStop stock. No,
Did you short or did you buy?
I'm retiring today, but no, but the GameStop thing brings up a whole other question, but I was not doing that today. But the stock market, while it can be irrational in the short term, is generally rational over the long term.
Yeah.
And so what you've seen is that in the short term, you've seen certain of the hot sectors that you would expect, including data centers, life sciences, industrial, self-storage, all have done very, very well this year. And the sectors that you would expect to do poorly included office, hotels, retail, and the senior housing, right? But that will bounce back because they are very difficult to underwrite today. How do you underwrite an office building in Midtown, inside the Loop in Chicago today, if it's multi-tenanted, has short-term weighted average lease term? How do you underwrite rollover, right? Very hard.
You're not calling that irrational though, right? Like
no, I'm not calling that irrational. So that's why it's actually somewhat rational in the short term. But if you have longer-term vision towards office, you say, gee, maybe that's an overreaction. And so one example of the overreaction was about 2-3 months ago when the vaccine was originally announced. On that very day, stocks in Central Business District office REITs went up by 35% in a day, right? Talking about how dependent it was about people getting back to the office. So I would say that there is opportunity in those areas that have been too beaten up, including offices, hotels, and retail. But there's going to be more volatility as the vaccine ebbs and flows, as the disease ebbs and flows. But you should just know that hotels always lead us into recession, but they always lead us out as well.
So there's almost a disproportionate number of real estate tech SPACs right now. Honestly, we're a proud beneficiary of one of those, where we rang the bell on Christmas Eve with Porch on the NASDAQ, and that was a 2020 way of going public via SPAC last year. So we're fine with that, and I think SPACs, they can provide a sort of non-traditional way for smaller companies to go public, which we're also excited about that as venture investors. But as an economist, what do you think? Short term, here to stay?
Well, the way the public markets work is and I used to be a REIT banker, so I remember the last time SPACs came around. But there are windows. There are windows of opportunity when it's time to do an IPO, when it's time to do a secondary offering, when it's time to do a SPAC. And the window is open now because of stock market valuation, and SPACs do provide a lot of the great benefits you just suggested. So I think it's a window. I think it's a good thing. I think you should. It's a sign that the market is, no matter how irrational it can be in the short term, it does provide rationality over the long term, and that rationality is getting when there's a low cost of capital and there's an opportunity and there's a good reason. There's a reason for SPACs, and so I think I think it's a good thing. But I don't think the window lasts forever.
Yeah. All right. Gonna hit the last two questions. Maybe we'll try to. First, I'll talk to you about the future of cities, and then I want to hear about some of your predictions. And we might take a question or two in between. So the future of cities, you kind of already said, you think they're going to come back. New York and San Francisco, they're going to come blazing. But, what about these secondary cities that are, suddenly becoming the hot markets? Like you said, Nashville, Denver, others like that. What do we see in the future there?
Well, I used to use a just an easy way of looking at these places, the 5 factors of awesome cities. And they were always the same, and it always had to come down to talent, foreign money, infrastructure, and a couple of other factors. And what's happening in these cities is they're really being led by talent, but there was also ease of doing business, which was my 5th factor of awesome. And by the way, there's a terrific study on the ease of doing business by Arizona State University, which ranks every city in America. You should read it. And now I'm going to give you the bad news about that study, and then I'm going to give you the good news about that study. The bad news in that study is that the big cities score poorly. San Francisco actually comes in last in that study in terms of ease of doing business. That's the bad news. The good news is the other big cities don't do well either. And so when you look at the ease of doing business, you can't compare, say, San Francisco to Oklahoma City, the city that came in last to the city that came in first. You have to compare San Francisco to LA, to Chicago, to Boston, to New York, all scored about the same. Not easy places to do business, but great places because they score so highly on the other factors. But going to the smaller cities, they are increasingly talent creators through their universities, but also talent attractors through either or through all of their ease of doing business, lower taxes, good climates, favorable to business, all the things that you would expect. So I think it's durable. They will continue to grow. But as I believe I said earlier in this conversation, the big cities are still going to get a disproportionate amount of the most highly educated professionals based on a study that we just did about New York and San Francisco. And those drive real estate demand. And so, yeah, smaller cities are now going to be more competitive to the major cities, but the major cities are going to come back and are still going to drive a disproportionate amount of productivity, highly educated individuals.
And what about migration data? We have a company called Unicast, and it's a little bit it takes a lot of information from your phone. We know a lot about you from your phone, and it's tracking mobility of humans, right? So everything from where the next hot new neighborhood might be, where people are getting dropped off at night, where they're commuting to work. How much decision making is being done by that kind of data today?
Well, data is the new oil, as many people say, or in a shameless plug, as was said on my podcast this week, where we talked about data privacy, and we were talking about the rise of how important data is, and not just your traditional data, but non-traditional data. I'll give you one funny story about mobility data, which is what you're talking about, Constance.
Yeah.
So there's a shopping center in northern New Jersey that I'll give you as a case study, where normally when you underwrite a shopping center, you put rings around it, 3, 5, 10 miles of how many people actually solicit that shopping center. In this case, since it was in northern New Jersey, they put the rings as big as possible so that they would encompass some piece of Manhattan, because everybody wants to say, oh, the people from Manhattan shopping, right?
Of course.
Of course so, and so here's the punchline. The median income of the people shopping based upon the traditional rings, which is about an average salary of $60,000, right? Well, 2 things. Number one, when they took real mobility data from their phones, they realized that nobody shopped there from Manhattan, which is, okay, the bad news. Here's the good news. When they saw the places where people actually shopped there using actual mobility data, the average income was $75,000. So they were actually selling themselves short by virtue of this mobility data. Now, the mobility data, we're just scratching the surface on its usefulness. I mean, it's sort of like we're sort of in the early stages. I don't know if you remember the rumble strips they used to put in the middle of roadways to count how many people are walking over or driving down the street. That's sort of where I think we are with mobility data today. But I think it opens up all kinds of possibilities, particularly for commercial real estate, not just to see better value for an individual asset, but for new pockets of value that we're currently not taking into consideration. And this is where, a lot of retailers are going to say, oh, we're never going to do this. This is where I think the industry is going. I think the industry is going to the place where the landlords and tenants not only share the relationship in bricks and mortar, they also share it in cyberspace, where the landlord gets a piece of internet sales. Right now, that's like blasphemy among retailers, but I believe that's where we're going. And mobility data will enable it, because your store isn't just a place to sell stuff. It's also a billboard. And many of the former cyber-only stores, the most notable being Warby Parker, and have gone from clicks to bricks because they realize you need this bricks and mortar presence. So I think that the more of a partnership relationship between landlords and tenants is coming, and I think mobility data will enable it.
Yeah, I mean, Unicast, as an example, they can track not only where you went to go visit that store, but then if you clicked on it later, right? So you get this feedback loop that just wasn't ever possible before. So
I want a piece of that click if I'm the landlord. I'm telling you, I do. And I think I earned it. I think I earned it.
So it'd be fun to talk about more about that later. So, okay, last question, and then we'll let you go. Thank you so much for everything. I want to hear about your predictions and what you're most excited about this coming year.
Well, I'll be most excited once the vaccine takes hold and the numbers of people getting sick and tragically dying goes down to or at zero, right? That's what I'm most excited about, because I do see that coming sometime in mid-year, certainly in the United States, but not globally, but certainly trending in the right direction. That's number one. But from a real estate and economic perspective, I am excited that after that period, this pent-up demand thing is the real deal. I was speaking the other day to Fritz Kagi, who is the Cook County Chief Tax Assessor. And he's a great guy, super nice guy, very smart guy. And we were talking about what's going to happen in the second half of this year. He said, quote, "It's going to be the mother of all comebacks." Now, the mother of all comebacks, a lot of people are saying the next 10 years are going to be like the roaring 20s were in the 1920s. That's certainly the optimistic case. But I think it's fair to say that a lot of the political unrest we're seeing today has some people foreseeing a darker future. I'm not there. I am certainly optimistic we're going to find a way to work out our differences, though in the short term, I'm not that optimistic, but over the longer term, I am. But I think pent-up demand, plus this complete shift in government policy with pumping money in fiscally and monetarily, plus I do believe that the work from home thing, while it's real and it will diminish some demand, is overblown. I think that we're going to see great demand going back, not only to these great big cities in America, but many of these secondary cities as well.
We are social people after all.
Why do people go to restaurants? You could cook at home every day. Why do people go to hotels? Because it makes you better, makes you happier. I mean, we forget this is not all reducible to a spreadsheet.
Yeah.
The human condition, however flawed, does like to buy and do stuff.
Yeah. All right, Spencer, thank you so much for being with us. This was really great. I really appreciate it. And again, thanks for tuning in to our speaker series, and we'll see you again next time.
Thank you, Constance. Please reach out anytime.